One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights, the only podcast dedicated to helping you learn both the technical and non-technical aspects of the investment banking process. And yes, we've been talking about technicals for over 100 episodes now because frankly, there's a lot of material to get through and it's important. But don't worry, we're going to get to the non-technical stuff also later this fall. But yes, my name is Alex Mason. I'm your host, and I'm really grateful that you're listening to me today. You could be doing a lot of other things with your time, but you're choosing to listen to this show and expand your knowledge. And I'm just grateful that you're here, and I want to make sure that it's worth it for you. So let's get into today's question. We're talking about mergers and acquisitions. How do you determine the M&A purchase price? How do you determine how much a company should pay for another company in an acquisition or a merger? And this is kind of just a general question. We've actually seen this kind of question before, just not within the context of M&A per se, but just the general question of what's the value of a company? And it all comes down to the same concept, and it's valuation fundamentals. So we're just going to revisit this concept real quick here for a minute or two. And these are the three main valuation methods. Number one, comparable companies. So we're looking at companies trading in the market that look similar to our target company, and we want companies that have similar financial profiles, similar geographies, similar industries, and we can use those as a basis with which to value our target company. The second major valuation method is precedent transactions. We're looking at transactions that have actually happened in the market, because what better evidence is there for how much a company is worth than to look at what's actually gone down and actually closed. Now, this doesn't say anything to intrinsic value necessarily, but we can say with reasonable certainty that, okay, someone else would likely be willing to pay X for this company if we find a very similar company in the recent past that also sold for X, if the companies are similar enough. So that's the second major method. And then the third major method for valuing a company is discounted cash flow analysis. We spent a lot of time talking about DCFs, all the basics. And what is this? Effectively, we're trying to understand the intrinsic value of a company based on its financial performance, based on how much free cash flow it's expected to generate from now until forever. So that's the method of discounted cash flow. And each of these three methods, they have the pros and cons. We've gone through the pros and cons time and time again within the valuation section of this show. So go back and listen to those episodes if you're a little rusty on those concepts. But fundamentally, that's what we're doing. We're looking at these three valuation methods. And then just a note here for publicly traded companies. If you're trying to figure out how much should be paid for a publicly traded company in an M&A transaction, it's usually going to be a little bit above the share price because of this control premium, and also because of the fact that if you can pay 15 to 30% above what the going rate is for the shares of a company on the stock market, then you're more likely to have your shareholders be happy, right? Your shareholders are going to naturally have this anchoring bias to whatever the current share price is. So if you can pay a certain percentage above that as the acquiring company, then you might get that deal approved a little bit faster than if you try to pay, exactly what the share price is or just a little bit above what the share price is. So just a little caveat there for publicly traded companies. But what do you do? Fundamentally, we're talking about M&A. You're talking about the three major valuation methodologies. Remember, precedent transactions, comparable companies, and discounted cash flow. So that's what I got for you today on Investment Banking Insights. My name is Alex Mason, and I'm your host, and we are rolling through these. I got to check and see how many more episodes I have planned for M&A, because I'm like, wow, we're going through these pretty fast. So thank you for listening, and have a wonderful, wonderful day.